$1.83 trillion. That's what Americans currently owe in student loan debt right now, up 3.3% from just a year earlier. It's now the second largest category of consumer debt in the entire country, bigger than credit cards, bigger than auto loans, second only to mortgages. But here's what almost nobody tells you. The interest rate on your loan is not what's making you poor. It's not even the total balance. It's the 10 years you spend not investing while you pay it off. That one decision, debt first, investing later, can quietly cost the average borrower more than $300,000 by the time they retire. Not in payments, not in fees, in growth that simply never happened. Money that never got the chance to exist. Let's prove it. With actual numbers. Picture two people, same age, 22, same starting salary, same $300 a month they're able to put toward their financial future. Person A has no student debt. She starts investing that $300 immediately every single month without interruption into a simple index fund. An index fund just means owning a small slice of hundreds of companies at once instead of betting everything on one stock. Boring, automatic, unremarkable to look at. Person B has debt, a completely normal amount. He spends his first 10 years sending every spare dollar toward paying it off completely before he starts investing that same $300 a month. Same discipline, same income, same market conditions. The only difference between them is when they started. By the time they're both 60 years old, Person A's account holds roughly $675,000. Person B's holds roughly $310,000. Read that again. Same monthly amount, same market, a gap of over $365,000 created by 10 years. That's not a rounding error. That's not a small trade-off you make up for later. That's a house, paid off in cash. That's a decade of retirement, fully funded. That's the American dream, quietly deducted from an account you weren't watching. And it happened without either of them making a single bad decision. Person B didn't overspend. He didn't gamble. He did exactly what he was told to do. Get out of debt first. That's what makes this so dangerous. It's not a mistake of laziness. It's a mistake of order. Now, here's where it gets uncomfortable. If you're currently throwing every spare dollar at your student loan to get free as fast as humanly possible for a huge number of borrowers, that instinct is mathematically backwards. Here's why, in just a second. First, meet someone real. Take a borrower who graduated with a current average bachelor's degree debt load around $29,560, which puts her right in line with national numbers, not some extreme outlier case. Federal loan, moderate interest rate, standard 10-year repayment plan, the default most people are automatically placed into. She has two paths in front of her, and she can only walk one. Path one, throw every extra dollar at that loan. Live tight, skip the upgrades, be debt-free in 6 years instead of 10. It feels incredible. It feels responsible. Her friends are impressed. Her stress goes down the day that balance hits zero. Path two, pay only the minimum required. Take every one of those extra dollars and redirect them into a retirement account instead, starting immediately. Same 6 years, same extra dollars, two completely different destinations. Because path one is racing against a fixed interest rate that doesn't change no matter how well the economy does. Path two is riding a market that has, historically, over long periods, grown faster than that rate. 20 years later, the gap between these two versions of her isn't small. It's the difference between retiring comfortably and working 5 extra years to catch up. This is the part your loan servicer will never explain to you because it's not their job to. A loan isn't just a debt sitting on a piece of paper. It's a delay. Every extra dollar you send early is a dollar that doesn't get decades to grow somewhere else. Instead, so which path is actually correct? It depends on exactly one number. Your interest rate, that's the entire test. And it's exactly why pay off all debt as fast as possible, no exceptions, isn't universally good advice. It's only good advice sometimes. The rest of the time, it's costing people 6 figures without them ever realizing it. Think of your financial life as a ladder. 5 levels. Skip a level, and everything you build above it stands on nothing. Level 1, the buffer. Before anything else, before investing, before extra payments, before any of it, you need 3 to 6 months of essential expenses, sitting somewhere safe and boring, not growing, just there. Because without this cushion, one car repair or one medical bill doesn't just hurt, it becomes brand new debt, stacked directly on top of the old debt you're already carrying. This is the floor. Skip it, and every level above it is unstable. Level 2, the free money. If your job offers a retirement match, that match is an instant, guaranteed return that no loan payoff on earth can compete with. Skip this level, and you are voluntarily leaving money on the table that already has your name written on it. Nobody climbing this ladder correctly skips a free rung. Level 3, the interest rate test. This is where the suspense from earlier finally gets resolved. High interest rate, meaningfully above what long-term markets have historically returned, attack that debt hard and fast. But a low interest rate, especially a flexible federal loan, history suggests investing that extra money tends to outperform paying it off early. Not always, not guaranteed. But often enough, over enough decades, that treating debt payoff as the automatic top priority is the wrong default for a massive number of borrowers currently doing exactly that. Level 4, the tax-free climb. Picture a quick comparison. 2 savers, same income, same monthly contribution. Saver 1 puts their money into a regular taxable account. Saver 2 uses a Roth IRA instead, a retirement account where you pay tax now at today's rate, and every dollar of growth after that comes out completely untouched decades later. Same market, same years, same discipline. The Roth saver simply keeps more of what the market handed them because nothing gets skimmed off the top on the way out at the end. For someone early in their career, likely sitting in a lower tax bracket than they'll be in later, that's not a small edge. It compounds right alongside the money itself, year after year invisibly. Level 5, automate and forget. The final rung isn't really a strategy at all. It's a system. Set the contribution once, make it automatic, and remove yourself from the decision every single month going forward. Willpower runs out eventually. Systems don't get tired, don't get tempted, and don't negotiate with you on a hard week. 5 levels. And here's the mistake almost everyone makes. They don't climb them in order. They throw everything they have at level 3, while level 1 doesn't even exist yet. They obsess over optimizing level 4, while free money at level 2 sits completely unclaimed. Order matters as much as effort does. Here's the part that should actually change how you feel the next time that loan payment leaves your account. You didn't fail by borrowing for school. Nobody handed you this ladder at 18 years old. You were handed a bill, a pen, and a vague promise, and told to figure out the rest on your own, usually before you'd ever filed a tax return. But the 2 people in that first example, they didn't start with different incomes. They didn't start with different discipline, different willpower, or different luck. They started with a 10-year head start, and a head start is just time. And time is the one single thing compounding can never hand back to you once it's gone. So look at your loan payment differently starting today. One part of it is paying off what you borrowed, and that part is necessary. But the other part, the invisible part, the part that never shows up on any statement, is either quietly buying back your future or quietly costing you a version of it you'll never get the chance to meet. $1.83 trillion is the number on the news tonight. $360,000 is the number that's actually about you. The dream isn't broken. It was never broken. It's just been waiting patiently for you to climb the ladder in the right order, starting with the very next dollar you're about to send somewhere.